Good day, everybody. My name is Lazarus Amukeshe, and it's been quite a while without posting anything. So today we're back again to look at economic indicators in the country. So we're going back at least 3 months of all the indicators that were released during the period. But specifically, we're going to look at GDP and then the private sector credit extension. And again, I've invited Eloise to Plessis. She's the head of research at PSG Namibia. Eloise, welcome.
Thank you, Lazarus, and welcome to all our viewers.
Yes, it's been a while.
Yes, too long.
Yeah, Eloise, one thing that was kind of, I don't want to call it disturbing, but also shocking to me is the GDP figures that we saw as released by the NSA in September. And what I saw, I was expecting a very huge contraction, but what came up was somewhat very encouraging to see that the damage is not that severe. But just help us take us through to really see what really happened with the Q2 figures. We have been waiting for them for so long, and then they were finally here. So just help us take us through them.
Yes, I'd like to chat through what happened on the GDP figures for Q2, just so that we can understand what is what can recover and what is more long-term problems for the economy. Yeah. So we saw that it declined by 11% for the year. There was actually a few factors that influenced this. So if we have a look at what were the things that declined a lot, it was the worst ever quarterly GDP figure that we've seen. But to a certain extent, we dealt with the pandemic and all of the international travel that was just gone. Yeah. So our agriculture and forestry, that's where the positive part of this came in, showed an increase of 47.2%. And that was, due to better crops, the drought was broken, and it came off a very low base. ICT also showed a very good uptick. That was, everyone was working from home. There was a lot more discussions, not in person, but over the phone. Yeah. So that's why there was an uptick there. And one would expect that for the health sector, there would be an uptick as well, with the money that was pumped into the economy for the pandemic. The big losers: hotels and restaurants, down 64.2%, manufacturing down 30.8%. And if we just look at some of the other things, the wholesale and retail trade also really suffered, transport, and then on your admin and support also a decline. The manufacturing actually is made up of things like beverages. This is now our Nam brews that we're thinking about, and the Coca-Cola plant. Those things declined by 51%. Basic metals also down, and diamond processing also down quite a lot. Our mining and quarrying declined by only 2.7%, and uranium production down 16.9%. So which of these things are going to bounce back as we move out of the COVID world in Namibia? Hotels and restaurants definitely would be one that we expect to see quite a big recovery. Wholesale and retail trade as well. On the transport side, I think there would also be an increase. The big problem is our international tourists who are all missing in action here. And before there isn't a better outlook for the virus in Europe, I don't know if we're going to see a big return of those travelers to Namibia. So that makes it tough. So we still are expecting a real GDP decline for the year of 7.4%. and then a growth of 4.7% for 2021. But remember now that 4.7% increase for 2021 comes off this extremely low base that we have in 2020. So while the easing of these containment measures and the conditional reopening of our borders should support some of a bounce back, the recovery is still expected to be very slow until we have a medical breakthrough that will improve the global confidence. And looking at the mining and quarrying, that weak outlook for Namibia's export commodity prices and economic growth in our regional partners really puts further constraint on the economic recovery. Now, what did our government try to do to boost the economy? One of the big things was the decline in interest rates, right? So if we look at this graph, the top line is the rate that the banks are lending out to you at, right? So this is the prime lending rate, and we can see just how much it has fallen, from around 10% to under 7%. So there's been really a huge decline in interest rates as the repo rate has fallen. Together with that is the deposit rate. So remember, it's not only people borrowing money that's affected by a decline in interest rates, it's also people investing money. So we've seen that you're getting much lower rates for money that you're putting away as savings in treasury bills or even just in a bank account. You're getting much lower interest for that. And now the question is, did that mean that there was an actual uptick in private sector credit extension? What is private sector credit extension? Again, it's just the loans that are given out in the country. So to households and to businesses, we look at how these loans grown. And there was, in August, there was some signs of life when private sector credit extension growth was at 2.6%. But in September, it came down again. And so the growth in private sector credit extension for September was just 1.8%. So that means from September 2019 to September 2020. So let's have a look at how this decline in interest rates has actually, how has that affected private sector credit extension? And again, what is private sector credit extension? That is simply the loans that are given out to businesses and to households in the country. So we saw in August that there was a bit of an increase, so a 2.6% growth in the loans, but that has fallen now again in September. So the growth is now on a year-on-year basis just 1.8%. So that means that at the end of September 2020, there's only 1.8% growth from September 2019. And what happened was that businesses, the credit extended to businesses fell again. So it declined by 2.2% in September. And the big problem there is mortgage loans for businesses that plummeted 8.9%. So on a year-on-year basis, businesses have 8.9% less credit taken out for mortgage loans than in 2019. There has been some growth in overdrafts. So on the overdrafts, we are seeing a bit of an uptick. But this is meaning that either businesses are paying off the loans for their properties, so they're definitely not buying new properties. It could mean that property prices have fallen so much that they are actually buying properties, but they're taking out much lower loans to buy those properties. Or it can just mean that they're not buying new properties; they are just paying off the ones that they have. So the low interest rates haven't enticed businesses to loan or to borrow more money. And then if we look at households actually ticked up a bit, right? So they're at 5% where they were at 4.3% in August. And that's in all categories. So we're seeing more demand for mortgage loans and more demands for other loans like credit cards and things like that. The installment leases are still down significantly. So we're not seeing a tick up in the installment leases at all. So in terms of an overall view, even though interest rates have fallen quite a lot, there's been payment holidays for borrowers and liquidity relief measures and loan schemes to encourage credit extension. The sharp contraction in our economic growth that we spoke about previously has really sapped domestic credit demand. So there are not a lot of businesses or people really wanting to take out more loans at this stage.
Eloise, thank you so much for that overview on the private sector credit extension and just the whole GDP numbers. But again, I just want to ask one question. So let's assume interest rates are going to remain on the very low until, say, early January. How do you see credit uptake throughout the remainder of the year, November, December, even early January? Can you maybe foresee that there'll probably be an uptick, or it will just remain going on the down?
We'll have to see what December looks like. December is typically a month where you have quite a bit of consumption. So maybe people, feel that they should reward themselves a little bit after all of the lockdowns and all of the pandemic and all of the bad things that's been happening, and people decide to splurge in December. And they might borrow more on credit cards, and they might spend more. Or the other possibility is that people are just realizing, listen, I lost my job, I don't have any extra money, and there's not going to be a big Christmas this year. But I do think that there might be a little bit of pent-up demand, so we could see a bit of increase in the credit extension. A silver lining scenario is that property prices might come down so much that young people can buy homes, and that might drive a bit of household credit. But we will only see businesses taking up credit once there's business confidence back. So if businesses feel confident, if businesses feel that the policies are in place for them to grow their businesses, then only then will we see that businesses take up loans again. So in my mind, the low interest rates are great, but if there's nothing to expand your business for, then there's no point in borrowing money for that. So we really need business confidence in order to see an uptick in credit again.
Okay, great. Eloise, thank you so much for always taking out the time to explain to our viewers on all the important economic indicators that we have for Namibia. And again, the next numbers are in December, I think, the repo rate. We'll probably have a close on that as well, and just see how everything has performed then. Until then, Eloise, thank you so much for taking out the time. Thanks.
Thank you, Lazarus.
All right.
Hope to chat again.
All right. Yes, and that was Eloise du Plessis, Head of Research at PSG Namibia, bringing us a breakdown of the GDP numbers for the second quarter, as well as the private sector credit extension numbers for September and August 2020. Thank you for watching, and do subscribe to the Namibian YouTube channel. Cheers.